On September 16, 1992, the British government lost billions of dollars in taxpayer wealth in a single day. During that same 24-hour window, George Soros made over $1 billion in personal profit. He was betting against more than just a bank. He was taking a $10 billion position against the full political might of the British state. It was a moment that proved an individual investor could legally force a sovereign nation's central bank to its knees. The conflict began with the European exchange rate mechanism, a system designed to link European currencies together to prevent wild fluctuations. This chart illustrates the core rule. Every participating country was obligated to keep its currency value bouncing between these two rigid horizontal boundaries. When Britain joined in 1990, they locked the pound at a rate far higher than their economy could actually sustain. You can see the result here. The pound was constantly sinking, pinned against the lower limit of the allowable band. To prevent the pound from falling through that floor, the government had to make the currency attractive to hold. They did this by keeping domestic interest rates high, a move that made borrowing expensive for every business and homeowner in the country. While politicians insisted the rate was sustainable, the Bank of England was quietly burning through its reserves, spending billions to buy its own currency off the market just to maintain the illusion of stability. The British government was actively damaging its own domestic economy to defend an exchange rate that no longer matched its economic reality. While the public heard a narrative of government strength, Soros focused on the deteriorating data. He saw a gap between what the government said and what the math allowed. He quietly built a $10 billion short position, a massive bet that the pound would eventually lose its value. His strategy relied on asymmetric risk. His potential losses were limited, but the potential gains were enormous. If Britain held the rate, Soros would lose a small percentage. But if the pound devalued, the payout would be historic. Soros knew the bank's reserves were finite. He just had to wait for the market to realize. The Bank of England hit the panic button. They hiked interest rates from 10% to 12% to lure in buyers. The market didn't buy it. Instead of moving into the pound, traders followed Soros's lead and kept selling. By that afternoon, the government doubled down, announcing an unprecedented hike to 15%. This move backfired. The market recognized that the British economy couldn't survive 15% interest rates. The threat wasn't credible because the underlying math made it impossible to maintain. At 7 p.m., the government surrendered. They withdrew from the ERM and let the pound's value be set by the open market. Without the artificial government support, the pound plummeted, losing 15% of its value against the German mark almost instantly. The collision between political will and economic reality ended in a total collapse of the state's position. The UK Treasury later confirmed the cost. £3.3 billion of taxpayer money vanished in a single afternoon of failed currency defense. On the other side, Soros walked away with over £1 billion in profit. His success didn't come from secret information or superior technology. Soros won by trusting his own analysis over the official narrative. He saw a government broadcasting certainty while its bank vaults were emptying, and he realized the numbers didn't support the story. Black Wednesday remains the ultimate proof. Whenever an institution's narrative conflicts with the underlying math, the math eventually wins.